All right. Well, if you're continuing to listen, thanks for listening. And now I'll go into where I think the equity market is going to be in the forecast that I have. So not to be too surprising right now. I see, and this is just for the S&P. So what I see right now for the S&P, and I'm picking an ending value of about 2,900. I think we could possibly get there this year. But I do have a range, and I'll get to the range after I kind of go through this and kind of lay out what I'm thinking about and how I logically coming to the conclusion that the S&P could go to 2,900. And so what I think ultimately, one is earnings per share from the market this year for 2019 was $173.63, and ultimately the market was pricing in 7.2% revenue earnings per share growth in the S&P 500 versus last year of 2018. So I'm not that aggressive, and I think based on my base case for GDP and how I've laid that out, meaning that I think that growth is going to be above trend, but only at 2%, 2.06%, and I'm factoring into GDP, and then I'm also taking into some of the things that I thought we're going to add to GDP and some of the things that I thought we're going to take away from GDP. So obviously I'm extremely bullish on the U.S. Energy sector at this point in time. But what I think is that for the S&P 500, I only see growth. I'm targeting at about 3%. And so my ending value for the S&P 500 would be $166 and about 86 cents. What that translates to in terms of the overall market return is about between 4 to 6% growth, and 4 to 6% return on the S&P 500. Meaning that I'm basically assuming that as of now, dividends are going to be about 2%, maybe 2.07%. Plus, you look at 3% earnings growth, that's about 5% return for the S&P 500. I'm not very aggressive. I do have a worst case scenario. This is my base case scenario. But ultimately what it does is it puts the forward PE a little bit more closer to the historical average of about 14, so it gives it about 15 PE, which is about a dividend yield on the S&P of about 6.49 earnings yield of about 6.49%. So it still makes the equity markets fairly attractive given that outlook. But then when I move into, when I give you the information on where I see the equity market going from 2019 all the way to 2020, it'll probably make a little bit more sense. Given that I see 3% growth, I think volatility is likely to remain elevated. So volatility last year was about 16.64%, which is basically the same as saying, we expect the S&P to move about 1% on a daily basis. However, I think volatility is going to be about 18%. In 2019, and we probably should see moves about 1.1% to 1.2% on a daily basis. Dividend growth, again, I think last year I think it was 8%. This year, probably 9%. But again, I think the dividend yield is going to be about 2%. So again, the equity return for me for 2019, I think. We could possibly hit a high of 2,900, but I really only see from last year's closing price 5% growth in the S&P 500 in terms of equity. 5% return on the S&P 500 this year, given where I think earnings per share growth is going to be to close out the year, which again is at 3% for me. And so the next thing I'll go into though is that the market is very, very aggressive. So the market thinks in 2020 we'll be at $192.96. So we'll see 11% growth from 2019 to 2020 in the S&P 500. I'm strongly not in that camp, and I strongly disagree with it for a number of reasons. And I'll go into some of those reasons after I lay out the 2019 through 2021 base case scenario. So like I said, I see 3% growth between 2018 and 2019, which puts me at about $166.86 for the S&P 500. I think that, if you look at a historic PE of 14 times, that puts my range on the S&P between 2,336.04 at the low end and then 3,000.348 at the high end, which would be about 18 times. So if the market were able to rally all the way to 18 times, you could potentially see like I said, about a 5% return on the S&P 500. So that's sort of kind of the range that I'm in. Obviously, the dividends would be a little bit lower. Obviously, they'd be closer to 1.8%. Now, for 2020, I only see growth, again, because I'm saying that we're going to see deceleration in the economy. And I still see and still would expect that we have a V-shaped recovery where we have a recession in the first quarter of 2020. The Fed cuts rates in 2025 in January. 25 basis points is where my base case is. Market quickly recovers in the third quarter back to trend growth. And we see S&P 500 earnings per share growth at $170 and I'm sorry, we see the growth at 2%, the growth rate in EPS growth for the S&P of 2%, and then we see where I think EPS is going to finish at $170.20 for 2020, which gives me a range, of again about 2,400 to 3,100 for where the market could be in 2020. And again, I think the market would most likely rally in the second half of the year for 2020 moving into 2021. And again, a lot of that has to do with the competitive advantage that the U.S. has after a recession, and it's able to rebalance over to the export sector, and see how that ultimately plays out with the change that we'll probably likely see in global current account deficit countries versus the former global current account surplus countries, the larger ones, and how that ultimately plays out. And then in 2021, that's where I see the market actually making the big recovery, and we see equities really rallying. So ultimately in 2020, I see the equity market only returning about between 4.27% and 3.8% in terms of the S&P. And then in 2021, I see growth being 8%, again driven by that rebalancing from consumer, or the rebalancing meaning that export sector should own a larger share of the growth in the economy, and the consumer will be reduced down to a little bit less, and it should have a positive effect on the U.S. economy in that sense. So in 2021, I see EPS growing 8%, and the S&P 500 being at $183.81, which gives me a historic P if I did it at 14 times earnings between 2,573 and then 3,308. So we could be up to 3,308. And the big return, I think, is going to be 2021, where you get, finally a double-digit return of about 10%. So between, 10% and maybe 11%. The other case, though, is the worst case scenario. And the worst case scenario, so what I just gave you was my base case scenario, which is ultimately over the next 2019 to 2020 to 2021, I'm expecting growth of about 4.33%, with the biggest year being 8% growth in earnings per share in the S&P 500 in 2021. The worst case scenario obviously is a lot worse, where I see negative growth in 2019 of 3%, negative growth of 2% in 2020, and then a gigantic, again, V-shaped recovery in 2021 of 16% growth, where the market in 2019 is negative 0.55% return for the S&P 500, is basically 0% return in 2020, and then there's a gigantic jump to 18% return in 2021 based on those fundamentals. So and the difference is that we go from 162 for 2018 earnings per share to down to 157.14, and then again deceleration into 2020 puts us at 154, and then the economy recovers in 2021. Part of that's going to be led by obviously automatic stimulus in the government finance and expansion of fiscal capacity, expansion of fiscal spending, but also the energy sector and the rebalancing from consumers carrying a substantial amount of current account imbalances, and then switching those over to the U.S., being able to export significantly more and switching that from domestic into the export sector, because again, the dollar is ultimately going to depreciate over the course of that period. So those are kind of the ideas, and how did I get to some of that, and how did I come to the conclusion on my 2019 prices and also the recession 2020 theory. So a lot of that has to do with what corporations did with the tax cut in 2018. When you ask yourself, where did the money go? And the money went directly into share repurchases and buybacks, and dividends. Also some mergers and acquisitions, but also paying off debt, and then some capital spending. So if you look at and you say, well, where did the $3 trillion go? Well, $1 trillion went to buybacks, and 500 billion went to dividends, right? So $1.5 trillion went to share repurchases and dividends. And then, I'm not sure the actual amount of in terms of mergers and acquisitions, but let's hypothetically say it was $1.7 trillion that they gave back to shareholders. And then they paid off some debt, and then the rest was spent in capital expenditure. So if you look at 2019, the corporations, and I like to kind of use the OPEC analogy, and to say that certain large corporations almost act as a stabilizer in terms of the market, because they're such large purchasers of their own shares, and they're also the largest purchasers in the market, and they've been the largest purchasers of equities for the last 5 years. Part of that's going to slow in 2019, and that's partly going to weigh on the equity market, but it's also going to increase volatility, because share buybacks ultimately act as a volatility suppressant, because it allows realized volatility to fall substantially, which creates an opportunity for people to do yield searching behavior, where they actually do call overriding and sell substantial amount of dispersion into the market, which again pushes down realized volatility and lowers it, and creates those situations where you have relatively small moves in the S&P, where you see like the 0.5% on a regular basis moves versus the 1% moves that you're getting right now, where volatility is elevated, and you see these very, very large swings in the market where it's two-way. So the headwinds right now that I see, and the biggest headwind that I see the corporations, is the strength in the U.S. dollar in Q1 into Q2, and that's ultimately going to put pressure on earnings, and it also impacts earnings from the rest of the world. So the dollar strength in Q1 and Q2 2019 is going to have a negative effect on earnings, and it's obviously going to slow corporate revenue growth. The other thing that's going to affect that is that I talked about the labor market being very, very strong, and if the labor market continues to get stronger throughout the course of 2019 all the way into 2020, even with a recession in the first quarter of 21, you're going to be subject to rising labor costs that corporations are going to have to pay out. Again, that's going to be margin compression. And that's going to be capacity constraints. And the other thing too is that relatively low productivity is also going to act as a constraint. So some of this is going to directly affect share repurchases. So the yield that they were receiving on share repurchases, they're not going to have as much cash available to do those share repurchases. They are the largest buyer of equities in the market. So there's not going to be another substantial buyer like corporations that can step in the market unless foreigners come back into the U.S. market, which they're not likely to do. Well, I shouldn't say that they're not likely to do, but I don't think they're likely to do that in 2019 as aggressively as they did that throughout the course of the last 2 to 3 years. So it's going to have an impact in probably in the Q3 of 2019, and will impact additional purchases. Where it's actually going to have a benefit is during the start of the second quarter, though. So share buybacks are relatively going to be probably not. They're not going to be as large as they were last year, but they're going to be sizable in February and March. And those share buybacks, actually, probably the March ones, in combination with an agreement on the China trade situation, could push the equity market higher. And also, I think there's going to be a surprise opportunity where the OPEC meeting in April is going to force the Saudis to cut production, because they're competing with lights, and if the U.S. production continues to increase. And this is all going to be talked about in the next set, where I talk about the crude market. So I think the March through April, the March repurchases are probably going to have an impact that's far sustainable on pushing the equity market a little bit higher to start the year. But I think ultimately that fades away. And then you think about the May through August, so the end of the third quarter. The start of the third quarter and the end of the third quarter, you could probably see substantial buys that would be remaining, but they're not going to be enough to really offset like they were last year. I mean, last year they had a substantial effect on realized volatility. I mean, realized volatility substantially dropped, and I like to call it the Tim Cook put, because Apple was a substantial buyer, and they had purchased almost $91 million, $91 million worth of their own shares at that point. I mean, they did 100 million to end the year, but they had a substantial impact on realized volatility all the way from May until especially into August, and even into September with some of the buybacks, where you had realized volatility on the equity market that was substantially below the historic volatility on U.S. Treasuries, which didn't make a lot of sense at that time. So that's sort of kind of where I see the market, and sort of kind of the reasoning behind why I see the market probably at best probably returning about 5%. And that's sort of kind of where I see everything, or I'm sorry, where I see everything. That's sort of kind of where I see the market price going into 2019. So if you like this and you want to continue to listen, the next video would be about the crude market and what I think is going to be a surprise from the Saudis in April, which could influence inflation expectations, and also it's going to be influenced by the weakness in the dollar as well. And then the last video that I'm going to post is going to be just talking about the twin deficits and sort of kind of the effect that they're going to have on the U.S. Treasury yields in terms of the market being able to absorb the reduction in the Fed's balance sheet, as well as the issuance from the Treasury throughout the year, or throughout the next couple of years. So if you like it and want to continue to listen, let me know. Thanks.